So speaking more broadly, you've said that we're in something, I think you called it an epic bubble right now. I think you've been very careful to say, I'm not going to predict when it ends. I'm just going to say that it does end. What's going to bring it to an end?
The thing about the Great Bubbles, 1929 Japan, no one knows after all these years exactly why the bubble peaked. You can say with hindsight it peaked at the point, of course, of maximum euphoria. So there was no hint of darkness at the end of the tunnel. Everything looked absolutely splendid as the market peaked. And of course, as long as it looks absolutely splendid, everybody is happy. The thing about the great bubbles is how intensely do people buy into the idea that it can never break, that prices will never decline. The housing bubble of 2005, 2006 in America was a brilliant bubble in that description. You had people going out and buying a second house to rent because house prices never declined. Indeed, Ben Bernanke said US house prices have never declined. Of course, then they promptly did, but that is par for the course for the Federal Reserve. In 1929, there was a terrific buy-in, and you could read articles in the Ladies' Home Journal saying all you had to do to get rich was to buy stocks and hold on to them. And the same thing occurred in 2000, in the tech bubble. And the same thing occurred in the biggest bubble of all, which was Japan in 1989, when the Japanese market went to 65 times earnings. But in US history, I would say there's a bigger buy-in this time to the idea that prices never decline and that all you have to do is buy them than there has ever been, which suggests that when the decline comes, it will be perhaps bigger and better than anything previously in US history.
You've talked about the tech bubble in 2000 that you famously really did anticipate, but you paid a price for getting out of the market at that place because other people continued to make money. People who were value investors switched over. You stuck with it. At the same time, the longer that bubble goes, the bigger it gets. Does that represent the possibility for you to make more money when it does burst?
If you can handle going short, getting out of the way, yes, you can make a lot of money.
This bubble, in part, if it is in bubble, as you describe it, must in part be because of the amazing liquidity pumped into the world market, frankly, but certainly the Fed participated in that fully. We now, just this week, have some pretty staggering numbers on consumer prices, up over 6% annualized right now in the United States. To what extent will the pricking in this bubble come if the Fed needs to respond and really step on the brake and maybe do it even a little abruptly?
Markets peak when inflation is low and profit margins are high. It's not about growth. They like GDP to be very stable. They hate it bouncing around. It makes portfolio managers nervous. And our model that goes back to 1925 explains almost all the ebbing and flowing of bull markets and bear markets. And until June of last year. Starting in June of last year, is the first time that inflation, the #1 predictor since 1925, is ignored. If you want to explain today's market level, yes, you have handsome profit margins. Every bull market has a wonderful economy. Every bull market has a plentiful supply of liquidity. But every bull market before this one had low inflation. In order to explain today's market, you have to assume 100% ignoring of the rising inflation, which is quite remarkable. Yeah, We've never seen anything like this. We've just hit 6% today. That would have been enough in any market since 1925, and for all I know, long before that. It would have been enough to have crashed the market. But this time, the faith in the Fed is so complete that when they say it's temporary, we believe it. The Fed, in my opinion, hasn't done a thing right since Paul Volcker, who was brilliant. All of the others have encouraged a chain series of really dangerous asset bubbles. They rattle the economy. They're incredibly disruptive. The decline in 2000, 82% in the NASDAQ was the decline from 2000. The decline of the housing market, all the way back to trend and below, dragging the world with it. and all of the problems from bad mortgages and a 50% decline in the S&P. These have a terrible wealth effect. They make people feel poor, and they make people spend less. It's the last thing you want, and yet they have not learned. They overstimulated to get to 2000. They overstimulated in the housing market. They got 3 or 4% more people to own houses in 2007 than had ever owned houses before, and the consequences were dire. And have they learned? Absolutely not. So in this time, they step into COVID, and of course you needed to stimulate, but did you need to throw this much money all over the world so that it flows into the stock market and creates these meme stocks, just craziness that had Avis triple in one day in the last week? And why did it triple? Because in response to Tesla and Hertz and Tom Brady, et cetera, Avis said, hey, dudes, we're going to buy some electric cars too. Wham, it triples. You know, this is more extreme in scale and size of market cap than anything that occurred in 1929, even adjusted for the size of the economy.